This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to the chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Pippa's picture saying, looking for the downloads. Eric, let's cover crude oil starting with EIA inventory.
EIA printed a massive 9.6 million barrel drawdown on crude oil inventories, and that was really an 11 million barrel drawdown after you consider the additional 1.4 million barrels that was pilfered out of the Strategic Petroleum Reserve this week. That's the 13th consecutive drawdown from the SPR in a row at the exact time when they told us they would be refilling it. Cushing, Oklahoma building 1.2 million barrels, gasoline building 603,000 barrels, distillates building 124,000 barrels. U.S. production holding steady at 12.2 million barrels, unchanged from last week. The tape action, needless to say, was up on that massively bullish inventory report, but only far enough to get to the 13-day moving average. So it's going to be really interesting to see what happens over the course on Thursday if we can get above those short-term moving averages, let's say above $70, and particularly if we can get above $74, we've got a chance of a new uptrend in this market. Certainly seems like we're overdue for one. But for now, we're just grinding along here and probably grinding lower before this is over.
Yeah, Eric, I have the chart here on the crude oil continuous contract with the 200-day moving average. But what's clear is that we've been in over a year downtrend, and the pattern of lower highs, lower lows has been persistent as this distribution cycle is still dominant. What's interesting, though, is we've really entered a trade range where no longer is there any motivated selling on the downside. And it'll be really interesting to see whether or not the bulls can dig in and hold this major support line or not. In order for us to see even anything remotely bullish, we would need to come and re-enter back into that January to March trade range, which was up in the $75 to $80 range, which would start testing that 200-day moving average. I mean, that would be the basic minimum that we'd have to technically see for there to be a potential trend shift. And right now, there's just none of that. And so right now, oil remains in this downtrend, and we're going to see what catalyst ultimately emerges to make that turn. Nonetheless, let's move on to the markets here. What are you thinking here, Eric?
We're still holding the breakout well above the 61.8% Fibonacci retracement, which is at 43.09 on the S&P chart. That makes no fundamental sense to me, but that's what the chart's telling us, is that the market wants to rally back toward new all-time highs. Since my fundamental view is opposite of what the chart is telling me, I'm on the sidelines.
So, Nick, let's talk some levels. What levels are you watching on the S&P 500 here?
Spot price right now is 43.75 on SPX. You have a call wall above at 4,500 and a put wall below at 4,000. The implied move for the July 21st OPEX is 105. The upper expected move is 44.80, and the lower expected move is 42.70. We have key resistance above at 4,400, key support below at 4,300, then 4,250, 4,200, then 4,000. What are your thoughts here, Patrick?
Well, you know what? I put on that chart on page 4 with the 50-day moving average. And while we can speculate whether or not this ends with a bear decline or not, the key highlight is that the bulls remain very distinctly in control of this market. All dips are being bought. Even the consolidation that lasted over a week was just a modest 100-point pullback. After such a run, it could have easily been a 200-plus plus point consolidation, and it was accumulated and well defended. And so while at this moment, I would basically side with the idea that this market is capable, after we get past this June 30th OPEX, is capable of making another stab on the upside. Of course, I'll be watching whether or not it lacks momentum, creates a double top or a failed breakout on the upside that is given back right away. But there's just no evidence of that right now. So let's see whether or not the bulls can pull this off. In order for this to turn bearish, at minimum, we would have to get below 4,300 and start doing some technical damage to the trend. And that's going to just a lot of work that the bears would have to do in order to shift this trend that's been in play. Now, Nick, let's talk the NASDAQ here. What levels are you watching on the Qs?
So the spot price right now is about 365. We have a call wall above at 370 and a put wall below at 355. The key resistance area above is 378. Now, the implied move for the July 21st OPEX is plus minus 13 points. So the upper expected move is around 378. The lower expected move is 352. And key support right now is at 335 as well. So right now, I think we're going to see probably short-term bouncing in a certain range, but I'm not really bullish or bearish here right now.
Yeah, Nick, I mean, the leadership has been in the NASDAQ. And one of the things that I'm going to be watching is when the NASDAQ finally loses some of that momentum. And right here, it's still a pretty bullish chart, and the bulls are likely to give another stab on the upside. Be interesting to see when the moment comes when the momentum stops. But right now, the bulls are in control. We'll see what they can come up with. So moving on to page 6 on the VIX, we continue to see incredibly low volatility. It just shows the summer doldrums. What levels are you watching on the VIX?
So right now the VIX spot is 13.5 approximately, which denotes about 0.7 to 0.8% moves per day in the broad markets. I'm not inclined to really think that we're going to see a spike in the VIX unless we get some crazy out of left field event that unfolds. But right now it's hard to short volatility. It's better to be long, I would say, and with a longer term view, a few months out would be probably more appropriate, given that we've been seeing this tight range the past couple of months or so. We have FOMC again in July. That's where the lead up to that event may cause a spike in the VIX if the Fed does raise again. Now, moving on to page 7, we have the US dollar index. What are you guys thinking here?
No real change from last week. We're right in the middle of a wide consolidation zone, and only a daily close below 100 or above 105 would change that.
Yeah, Eric, I put that trade range in a box on the chart, and we continue to just see a consolidation in most of the currency markets. Obviously, the Asian currency markets are actually moving with a little bit of momentum still, but really, especially when it comes to the euro and even the pound, even though that's moving a little bit, it's been a very quiet currency trading range, and I think that at this moment, the dollar's waiting for some sort of a big macro event to really get underway, whether it's the economic slowdown or some other catalyst, in order to make a move out of this trade range. And right now, I don't see any reason to expect that breakout is imminent. I would probably anticipate that deep into July, we're still going to be talking about this trade range. Nonetheless, Eric, what are you thinking here on gold?
Gold continues to drift lower, just as I've predicted that it would in the last several weeks. I'm actually surprised that the selling didn't accelerate more after the 100-day moving average failed. My target is still $18.60. That's another $50 or $60 of downside from here.
Yeah, I put up that chart with the 50-day and the 200-day exponential moving averages. And the key here is that we're slowly approaching that 200-day moving average. This is, in my mind, a very important moment on gold. It's gold for the last month, for almost all of June, has just been in distribution mode. And in not aggressive one, but every rally fails, and it just continues to crawl lower and lower on the downside. This is an important support, and we'll see whether or not the bulls show up and try to drive this back above the 50-day moving average to potentially start some sort of a retest of previous highs. But at this moment, any breakdown further from here, there's no other target other than it returning back to the March low, which is near the 1800 level. So let's see whether the bulls can hold the line here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.